Joseph, great to have you back on Face. How have you been, buddy?
I've been doing well. Thanks so much for inviting me. It's a pleasure to be here.
Okay, well, it's great to see you. Uh, I'd like to start off with why don't we go with the elephant in the room? Your expectations for Powell's Fed this week?
Yeah, so I think so the market, just for context, right now, the market is pricing in two cuts this year. First cut starting in September. And I think that makes sense. And I think there's a risk that we can have probably three cuts this year. So the way that the Fed is looking at the world, it's about full employment and price stability, right? Now, when I
Yes.
read the Fed minutes, I'm getting the sense that there is some degree of polarization on the Fed's decision-making body. You have a group of people who are just saying, hey, look at unemployment rate, it's going up. Recently, we just got to 4.1. We got to pay more attention to our unemployment mandate, but you also have another group that is a lot more hawkish, and they're like, we still reserve the right to hike rates and so forth. So that
Yes.
degree of polarization, I think it's going to make things a bit more difficult for Chair Powell going forward, but the data is clearly moving in the direction of a slowing US economy and a more balanced approach where I think unemployment is going to be more important than inflation. Now, the
Okay,
Fed's
so
target, of course, is
yeah,
2%. But if you
yeah.
look at the data, we're at 2.6%. We're really not that much above the Fed's target. It doesn't seem to make sense for rates to be at 5.5%. So I think the risk is that we'll have more than two cuts this year.
Okay. Could that take the 10-year back to 350? Because technically, that's what I'm looking at here with this formation here. It's a descending triangle. And I could go back to 5% if I wanted to be more aggressive on the call. But, 470 to 420 is 50 bips. And 420 is a breakdown out of this formation. And you subtract 50 and you have 370 on the 10-year. Can you come up with a narrative that would get them there?
So I think that we haven't seen the lows. So I think we can go see, 4% on the 10-year because I do think the market is not pricing enough cuts at the moment. But I think much below that to me seems difficult because structurally speaking, there's a couple of things that I think that are going to have a secular upward trend in yields. One, of course, is that um, you have inflation that still is not going to go back to, I think, 2% or below. Will probably be around 3% going forward. Um, it's going to be volatile, but it doesn't seem like we're going back to that same regime we were pre-pandemic after the GFC. And the second is that we have tremendous amounts of deficit spending that's increasing
Yeah.
the supply of treasuries. So you got to have that higher term premium in the treasury market. So I would say that if 10-year will go down to 4%, I would think I would sell it. I would think that longer
Okay.
term, maybe within a few years, maybe within a year, we should see 5% on the 10-year again.
Okay. So this is just a temporary move to the downside in yields. The long end
So
of the
let me
market.
actually give you a little bit more color on that.
All right.
So when we talk about the 10-year yield, the market often thinks of it as, say, just what is the neutral rate for the economy? Where is the interest rate where the Fed is neither being restrictive nor accommodative? Now, I would expect that the 10-year, let's say the 10-year yield being an average of the path of policy over the next decade, it should be about, not too far from the neutral rate and a little bit above because you need a little bit of premium to compensate you for duration risk. Now, the market is thinking that the neutral rate is probably, say, 3.7%. It's volatile, but it's structurally higher than it was
Oh,
pre-pandemic. So if you
yes,
think that the
definitely.
neutral rate is about 3.7%, you add 100 basis point of premium, that gets you pretty close to 5%. And honestly, 100 basis points of premium is not a lot. And given the projected fiscal deficit, I think it should be higher.
Okay. So I want to move on now to something you blogged about, Joseph, and you use the title French Connection, like the movie, and you're talking about France having a big impact on the dollar. Can you explain France's role in how you're analyzing the dollar and what impact looks like the elections hung parliament. What you think, what you're writing about then about France, is it still valid after the 2 weekends we had elections?
So when I think about what's happening in France, I think about its connection to the US via the global banking system. What many people don't realize is that France is actually home to a few global mega banks that are very active in the dollar funding markets. And what these global banks do, say a BNP or a Credit Ag, um, SocGen, is that they will go borrow dollar funding throughout the world and invest in short-term arbitrage in dollar assets. It could be as simple as borrowing dollars somewhere and then just leaving it on deposit at the Fed, earning the spread between what you borrow at and what you earn in interest on reserves. Or it
Okay.
could be a little bit more complicated, where you would borrow money, dollars, and then lend it in the FX swap market. So the French banks serve as I think, a significant arbitrager of these dollar funding spreads. Now, what we saw when Macron called the French election is that we had turmoil in the French markets,
Yeah.
and we also had some of these dollar funding spreads widening out a little bit. Now, that seems to be greater caution on due to the banking sector, where if you have banks that are a little bit more concerned about the market, or they have less capacity to arbitrage, and so you could have spreads, let's say spot swap spreads, FX swap spreads, just kind of uh, be a bit bigger than usual. Now, that seems to be have the market seems to be a lot less concerned now. If you look at oat spreads to German bunds, it seems to have narrowed a bit. So I'm getting the sense that the market is happy with the hung parliament outcome that seems to be unfolding before us.
Okay.
So
You
that
have a
takes away
dollar
a little bit of
view.
tail risk.
I know you pay attention to currencies, and you have generally you have a view on the dollar. I'm pretty bearish, especially if we take out 104.5 here, Joseph. We tripped one trend line here last week. This looks like a failing rally to me. We get through 104.5. It opens it up for more downside in my work. And considering what happened in the UK, normally it's bearish when labor takes control. It may take some time, but I see nothing wrong with this British pound chart. I wouldn't short it. Your view on the dollar, and my other view is that commodity currencies are the leaders. Um, Aussie, one of the strongest out there. USD NOK under pressure, just like Canada. They both have oil in common. You have a view on the dollar, either as the dollar itself or in pieces, any particular fiat that everyone says is eventually going to be worthless, but I'm going to trade. I'm going to trade it until then. So you have
So
a
I
view?
think no, I agree with you. I think the dollar, there's some big things that are quite bearish for the dollar. Well, for example, one of the Trump trades is a weaker dollar, right? Now, betting markets give President Trump 60% chance of retaking the White House. President Trump, very open with you. He wants lower rates, he wants a weaker dollar. Now he can't directly control the Fed, but he does have direct control over the currency. That's one of the powers of the US Treasury. So if he wanted to depreciate the dollar, he has all the tools to do that, doesn't need anyone's approval. If he wants to do that, and
Interesting.
I think he does, then you could see a weaker dollar. But even if he does nothing, like the fiscal policy, that the fiscal trajectory that we're on, significant deficits, that's obviously very bearish for the dollar. So yeah, I think the dollar is not in a good situation. We could still have these counter trend rallies where we have global risk off events, but I think that government is telling you they want to depreciate the dollar, so I would take them at their word.
Yeah, I think it's going to be interesting since we haven't seen risk off for a while. to see how the dollar actually does respond. I think there's a possibility that we don't get that safe haven buying in the dollar, especially if things look pretty messy here in the U.S. Could you come up with a narrative, Joseph, where we could have a weak dollar and risk off at the same time?
That will be a very negative view of the world.
That
That's what you would see
that's
in
Paul's nightmare, isn't it? A weak
so
dollar and risk off.
so the way that I think this could happen would be, let's say that you tell the world that you want to depreciate the dollar. And if you are a foreign investor, you care about your returns in local currency terms, right? So right now, if you are a Japanese investor and you bought US stocks, well, great. S&P and Nasdaq went to the moon and the Japanese yen depreciated, so the dollar appreciated. You're getting a double play here.
Right.
Now, if you reverse that, saying that,
Yeah.
well, let's say that the administration wants to depreciate the dollar. Obviously, as a foreign investor, you don't want to take those losses, right? Because you're looking at things in local currency terms. So that could prompt you to kind of get out of the U.S. market.
Okay. I want
And
to
so
talk
that you
about
would
how,
have a dollar sell-off and also
yeah,
risk off.
that would be an even more difficult backdrop for treasuries, wouldn't it?
So for treasuries, I'm not as so. I think that we're on the path towards some kind of accident in the treasury market, but I wouldn't really be worried about that a lot because there are a lot of tools that the government can do to fix the treasury market. We've already seen people roll out this across the world and in history. Remember what happened in the UK a couple of years ago? You have an
Yeah.
accident in the treasury market. Bank of England comes and just buys a lot of gilts. If you have an accident in the treasury market, Fed could do the same thing. Um, Fed has done it before, all throughout the 1940s. You have some form of yield curve control, active involvement of the central bank. Now, these rates markets, these are things that are basically within the control of the government. So you can have accidents, but they will be short lived.
Okay. You want to address how monetary policy is creating shortages. Are you talking about rates being an inhibitor for example, building new housing, developing anything new because, you know, the world got used to free money, zero rates, 1% rates. And so there are shortages because things aren't being built or mines aren't being opened because of higher rates. Is that the point you were trying to get
Yeah, yeah.
across?
So I think that monetary policy, interest rates, has an uneven impact uh, on industries and on goods and services. We want to think that if you raise interest rates up, you decrease demand, and thus you can slow the economy down and get inflation down. But inflation, ultimately, it's not just about demand, it's also about supply. So if
Right,
you have high interest rates, you are obviously going to constrain supply in some industries. Now, one of the industries that obviously gets constrained by high interest rates is housing. Now, if you look at surveys of developers, if you talk to developers, they'll tell you that they're not building a lot. And you can see this in the housing starts. You can see this in a lot of data. They're not building because with rates where they are now, their projects just don't pencil in. So again, people look at this through the lens of cap rates. If you have interest 7% mortgage rates, even higher if you're trying to get a construction loan, these projects just don't pencil in because the cap rates are too low. So you are also constraining supply as well. Now it looks like we're at a point where higher interest rates could reduce the supply in some segments of the market and thus actually contribute to shortages and higher prices. Again, this impact is very uneven, but the way that the inflation in numbers are calculated, there's a very big weight for shelter inflation, which is to say
yeah,
rents. So
yeah,
if you have interest rates constraining the supply of housing, and at the same time you're importing millions and millions of people, increasing the demand for housing, obviously you're going to push shelter inflation higher. In that sense, for this segment of the market, high interest rates become counterproductive. And you can also see the same thing happen in Canada, which is a much clearer example where they had tremendous amounts of migration, high interest rates, and guess what? The rent just went through the roof, and it's making it difficult for the Bank of Canada to get to their target, largely from their own doing.
Yeah, and also, Joseph, they don't have 30-year mortgages up there in Canada. I think
Yeah,
they're
one of
mainly 5 and 10 year that are rolling over. And as they roll over, rates are twice as high for the mortgage holder. And it's different than the US too. You can't just walk away from your house without having other repercussions like liens against having your salary garnished or other assets. You can't just walk away like we can in the US.
Yeah, so I think that's one of the big reasons that they want to cut rates, right? So they've cut rates once, and they're expected
Yeah.
to cut rates. Continue through the cutting cycle. It's because monetary policy is a lot more effective for them when they raise or lower their interest rates. That feeds through the mortgage market to households in a cleaner way, like the way that you described. And so, you definitely have a lot of Canadians who are going to be surprised as they have to renew their mortgages in this current interest rate environment. That's
Okay. And their currency under 136 is going to strengthen. I normally that hurts an economy. Like if the euro turns good and I get things like, 115, 120 euro in 6 months or a year, um, could that be the nail on in Europe's economy as exporters, which it's a big exporter, Germany especially, has more difficulty doing so with the stronger euro?
so I think that, well, for Europe, I think when they think about exports, it's not just about to the US, but it's also to places like China and so
China,
forth. So
yeah.
that does seem to be impacting them. Um, about the currencies, though, again, like we discussed earlier, I think structurally the dollar is going to weaken, but I prefer to play this against, let's say, weakness against financial assets, because when you look across the world, all countries have their own problems. Now, even though the U.S. is definitely doing things to weaken their currency, maybe it would be more obvious to manifest in different ways, like financial asset inflation, or real estate, or things like that. So playing it against currency pairs for me has been difficult. For example, looking at CAD, everyone was saying that, seeing the points that you mentioned, Canada has to cut rates faster than the US and steeper because their economy is more rate sensitive due to the mortgage channel. But if you look at the Canadian USD exchange rate, kind of been range bound for the past year. So
Yeah, yeah, even longer. So yeah, it's almost been 2 years. Look at this.
yeah, and
You
strangely, it looks like
look at
someone
that.
is just defending that at 1.39. It doesn't want to go above that.
Yeah, and supporting it at 32. To me, it's just too long for me to consider this consolidation and accumulation. It looks more like distribution to me that's been happening since 22. And so if you break the bottom of the range, it could usually be a pretty big move. So, that's what I'm looking for eventually. Right now, this 36 is a level, but the big levels are down here. And it's counterintuitive with a bad economy or an economy under stress. You would think that Canada USDCAD be going up and weakening, not strengthening. So uh, I need economists like you to explain what I'm seeing. That's why I keep you. Can you give me a narrative to explain what I'm doing? Uh, anyway, why don't we wrap it with something I haven't heard you write about in a while, and you're talking about crypto rebalancing, and it's kind of a positive development in the crypto world. You want to address that?
Yeah, so as we've noticed that there seems to be a relationship between crypto prices and risk assets. There's some interesting
Except
research.
the last month.
Well, not yet.
Yeah,
So, except that, so people have looked into this and actually found pretty concrete links between crypto users and people and other assets. What they did was they looked at basically a huge database of 60 million bank accounts to try to figure out just what people do with their money. So they located among those 16 million users people who are traders in crypto. They did this by looking at their bank account data and seeing if they had transactions with big crypto exchanges like Coinbase. And they found pretty interesting things. One is that when people have big crypto winnings, they tend to buy other stuff. One of the interesting findings is that they noticed that when someone withdraws a whole bunch of money out of their crypto exchange, a few weeks later, their monthly mortgage payment goes up a lot. Now, the inference there is that, well, you took all your crypto winnings and you bought a house, a bigger house, and that's why your mortgage payment went up. And so you have this link where these YOLO crypto guys are actually, contributing to higher house prices. But what they also do is they also rebalance it to other traditional assets like equities. So that seems to be why there's a link where higher crypto prices, some guys sell their crypto and go and buy the NASDAQ and stuff like that.
yeah,
Now,
yeah,
I'm actually kind of surprised by what's happening in crypto right now. Where you see this just doesn't look good. Bitcoin doesn't look good, but if you look at the alts, they look even worse. But at the same time, you have the major indexes doing really well. So that seems to be pretty interesting. Either uh, the crypto is just ahead and we'll see follow through from the major indexes later, or maybe they're decoupling. I'm not sure.
or maybe they're a warning sign that there might be a little liquidity issue, which would also tie in with rates coming off for a little while.
Yeah,
Or
that could be as well.
yeah. So I just want our viewers to know where they could find you and where I was able to come up with questions to ask you about based on your writings. And if you're interested in the dark science of central banking, no one better to shed light on it than Joseph. He has courses
Yeah,
on.
so thanks so much for having me. If you're
Yeah.
interested, you can check out my website at fedguy.com. I also have a YouTube channel called Joseph Wang, where I will give you a weekly market debrief as to the big events that happen in the market every Saturday.
Okay. So there you go. I mean, uh, keep Joseph's views as part of your intelligence gathering for what you're trying to figure out to do, especially in markets that are closely related to the Fed. But he's got across the board coverage, as you could tell. And I always feel like I've learned something new every time I talk to him. So, again, my trading warrior brother, Joseph Wang, thanks for coming here again today and hanging out with our community and sharing your work with us.
Thanks so much, Coach. Great to be here. Happy trading, guys.
Oh, you did that on purpose. All right, Joseph. Anyway, nice talk. Nice talking to you, buddy. Talk to you later in the summer or the fall. Joseph Wang, everybody. And you could join the team in, it looks like 19 minutes on the morning edge. So we're in July. I don't want to hear about anyone starting to cry if they haven't joined our community. So good hunting the rest of the day, everyone. Oh, you're welcome, Mandy. It's fun for me to bring these guys on because the questions I ask are also questions, although I believe you want to know the answers, I certainly do. So, who better to ask the questions than has been asked the questions? And appreciate that. See everyone for Turnaround Tuesday. I have, Hal's Rethink tomorrow. So Harold Malgrim will be with us. I'm going to talk some politics with Harold tomorrow. The Donald Duck is unbelievable. He did that on. It was intentional. It's got a sense of humor. All right, everyone. Don't just count on to Mandano. Don't just count your pips. Count your blessings. See you guys tomorrow. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.